Hey everyone, hope everyone's having a wonderful day today. My name is YK and I'm a 24-year-old who loves talking about money. So let's talk about money. With that being said, I want to start my video today with a question. So the question is, what do JCPenney, McDonald's, and Disney have in common? So the answer to that is those three empires exist today. Well, JCPenney is going bankrupt, but that's besides the point. So those three empires exist today because their founders had huge cash value life insurance policies to draw from. They could draw from it to build their empires and to maintain their empires when things weren't looking very well, like financially. So life insurance is a great asset if you know how to use it. Like cash value life insurance is a great asset. This is why banks own significant amounts of cash value life insurance, right? It's called BOLIs, bank owned life insurance. So banks have cash value life insurance as tier one capital. Tier one capital means it's the safest asset for them. And later on in my video, I'll explain why. So if banks use cash value life insurance, would it make sense for the consumers to use that as well? And the answer to that is yes, if you know what you're doing. I mean, it might not be for everybody, but if you know what you're doing and you're in the right place in your life to get a cash value life policy, it could be a great thing in your financial portfolio. So one of the big reasons that people have a cash value life insurance policy is because of tax benefits. Because in a cash value life insurance policy, if it's structured the right way and you follow the rules, then everything that you take out of the cash value policy is tax free. So that is a huge thing because cash value life insurance is something you put your money into with the expectation that it's going to grow. So when the money grows, when you take it out in the future, you don't want to pay taxes on it. And I make this argument in my 401k and IRA videos, which I have somewhere up here. So to summarize what I say in those videos about taxes is that if you put, let's say, $10,000 into a traditional IRA or traditional 401k, and let's say you're at an average 30% tax rate that year, then you'll save $3,000 in taxes, which is great. But in the future, let's say this $10,000 grows to $100,000 and you take it on the future and you're still at the same 30% average tax rate. So taking out this $100,000, you would pay $30,000 in taxes. And that's if your tax rate stays the same. If it doubles, you'd be paying $60,000 in taxes. And is it possible that it'll double? It might, because historically the US is in a low tax bracket right now. We have no idea what's going to happen in the future. So it's good to not have to worry about tax in the future because we don't know where they're going to be, right? That's why we put our money into tax-free buckets. So the other tax-free bucket, the other popular one is a Roth IRA. And last video, I talked about the IRA right here. And I used to contribute to a Roth IRA until I found out about cash value life insurance. And it made more sense for me to put money into cash value life policy instead of my Roth IRA. So I'll talk about that later on in this video too. So right now I want to share about like what is cash value life insurance because it's not a very common thing. Most people, when they think about retirement accounts, they think about the 401k and the IRA. And most people haven't thought about cash value life insurance because they haven't heard of it or they don't know how to utilize it. And maybe it's complicated to them. You know, there are a whole bunch of reasons. So today I'm going to explain briefly what the idea of cash value life insurance is. So cash value life insurance is just an umbrella term, right? So you have cash value life insurance, and then it's split up into whole life and universal life policies. So to explain that, I'm going to go ahead and share my screen. On the left here, we have a whole life policy. So a whole life is on the low risk, low return side of cash value life insurance. The way you can think of it is you put money into a whole life policy and that cash value will grow at whatever guaranteed contract rate that's given by the company. It could be 2, 3, 4%. And that grows independent of the stock market. So low risk, low return because you know how much it'll grow. On the other end is the universal life policies. So at the high risk, high return end of it is a VUL, variable universal life. So what that means is the cash value in a VUL, it will grow with the market, whatever market you choose, with no cap. It'll grow as high as the market goes. But if the market crashes, the account value in a VUL will also go down with it. So in the middle, there is the IUL, the Index Universal Life, which is what I have. And the reason I like the Index Universal Life is because compared to a whole life, getting 2, 3, 4%, I can do better with my growing my money, doing other things than putting into whole life policy. And I don't want to put my money into a VUL because if I was going to put my money into an account that's subject to growing with the market and will crash with the market, I'd rather straight put it into a Roth IRA so I can ride with the market instead of having to pay for life insurance as well. So I like the IOL because it's like a not too hot, not too cold kind of thing. It's right in the middle. It'll grow up to a cap. If the stock market grows, it'll grow up to a cap. But when the market crashes, the IOL won't lose any account value, which is what I like. And I'll explain more about that in this next picture. In this picture, there are 3 lines. There's a blue, red, and green line. And each of these lines represents how money could grow in an account. So I'll talk about each one individually. So blue line is a line that grows consistently. And you can think of this as like a whole life policy, because a whole life policy, it grows consistently independent of the stock market. So you can see that growth as a straight line because you get a guaranteed interest rate every year. And on the other, like opposite of that, we have this red line. This red line is basically the market. So like you can think of it as a variable universal life policy. So back in 98, the stock market grows, it grows, it grows. And then what happened in 2000s is we have a market crash, the dot-com boom, dot-com bubble, not boom. And then from here to here, the account value drops 40, 50%. And then it goes up, goes up, goes up, goes up. And then 2007, 2008, we have a housing crisis, and then it goes down, and then it goes up, goes down, and then it, goes back up. So this is like a variable universal life because you can grow on the upside with the market with no cap, but it will also fall with the market. And then this green line is an index account, right? It represents the index universal life. So money grows with the market up to a cap. You see here that the green line doesn't grow as fast as the red line, but when the red line crashes right here, that you notice the green line, it stays flat, right? The account value in an index account stays flat. And then it grows and grows and grows and grows with the market, and then the market crashes again. And the indexed account stays flat. And then it continues going up. So with that being said, why would people want downside protection? So one of the main reasons is this. One of my friends, he's a CPA, good friend of mine, and he's a CPA. So back in 2008, when he was doing people's taxes, he always makes this joke. He saw people's 401ks go down to 201ks. Like they literally became half of their value over however 1 or 2 years. And, one, that's really sad because you think about it, you have $1 million 401k and it drops to 500, maybe 600,000. I'll be generous. And this is especially like bad for people who are about to retire because they don't have other sources of income. I mean, they might, but they depend mostly on the 401k. And if it drops by about half, then, you really probably don't want to take out money for your retirement. So this really affects people who are in retirement, who draw on their 401k, or people who are about to go into retirement. Because a 40, 50% drop in your 401k, how long will it take to recover, right? Will it take 5 years? Will it take 10 years? So that's why it's important for them. But let's say someone like me, right? For someone who's a 24-year-old, right? I'm 24 today, or Saturday. Why would I have a cash value life policy? I'm not planning to retire anytime soon. The reason it's valuable to me is because of this. So if I have to, the reason I want this account value to stay flat over here is because when the market does something like this, like back in 2008, which it may or may not happen again anytime soon, my guess is that it will because of everything happening. So the idea is if the market crashes, then my account value, my cash value life insurance stays flat. And then as the market declines, I'll be able to pick up cheap assets. I could be like, hypothetical example, right? This is not in year 2000. But if I was like, oh, hey, I see a cheap house here. It's like whatever, down 20% from its all-time highs. Then I can be like, oh, I need some money. I can pull out, let's say 100K from a cash value life insurance policy, right? I'll just buy a house right here. And then here it's like, oh, maybe a year later I find another house. So it's like, oh, I need another 100K. And I'm going to pull from my cash value life insurance policy here, right? The reason that's beneficial is because in order to buy a house, like during declining market, you either want cash or something that's correlated that doesn't fall with the stock market. Because if you want to buy a house in a declining market, so stocks and the market and real estate usually go together. So if real estate is down, chances are your account is probably down too. So it wouldn't make sense to take money out of like a brokerage account or a retirement account to fund the house because they're both down. That's why you want to have cash or something that doesn't fall with the market. But I would assert there's never going to be a time where I have 100K in cash because I wouldn't do that. I would just invest it all. And to me, cash value life insurance is a better version of cash because cash just sits there. Cash doesn't grow. I mean, your whatever 0.2% APR in a bank, I mean, it doesn't do anything. So I like the cash value life insurance because it does grow, although up to a cap, but when the market crashes, you don't lose any account value. And that's why it's valuable to me. And then this is not like a short-term game. I'm not like planning to buy a house. Well, I am actually, but the cash value life insurance game is not a short-term game because you can't put money in and then just pull it out. You have to wait till the surrender period is over, which for some companies 10 years, for some companies 15 years. So this is really long-term play. It's not that you can't take money out before the surrender period. It's just that you're hugely disincentivized to do it because you have to pay fees and all that stuff. So that's why I have my own policy, right? It's a long-term game. Now, the other reason I have my policy is because of, let me stop sharing my screen, is because of living benefits. So living benefits is like a fairly new thing in life insurance because everybody knows life insurance is something they have to die to use. Living benefits is this. So if I suffer like a terminal illness, a chronic illness, or a critical illness, critical injury, then I'll get paid out from my policy. So what it means is that the policy has some sort of death benefit, right? Any life insurance. And with living benefits, if anything happens to me, like if I get like cancer or heart attack or stroke, then the policy would take a portion of this death benefit and they'll give me a portion of it so I can still use it when I'm living. Like that is the value of living benefits. So say 30, 40 years from now, like if I have a heart attack, cancer, stroke, then rather than having to liquidate my assets to pay for my own medical expenses, then I'll get a windfall of cash from my life insurance policy, right? Depending on the type of condition and the severity of it. And this is just, it's a hedge, right? It's a protection for me. That's the point of any insurance. You pay a little bit monthly into some kind of insurance. You think car insurance, right? You pay a couple $100 every month. If you get into an accident, rather than having to shell out $10, $20, $30,000 to fix your car or fix someone else's car, that the insurance will pay for it, right? So life insurance with living benefits is no different. It's a hedge, a market protection. Indexed account stays flat if the market crashes, and living benefits. If anything happens to me, then the life insurance company will pay me out depending on whatever condition I have and the severity of it. And that is a must have for anybody who's like wanting to generate wealth. And even if you don't want to generate wealth, you just have that because in the US, it's just statistically likely you'll have cancer, heart attack, stroke, you know. So if none of that happens to me by the time I'm 66, which is my like retirement age for my cash value policy, then I'll be pulling out money tax-free for the rest of my life because there's a lifetime income. And this is a must-have in a life insurance policy because lifetime income means when I'm 66, they're going to take a look at my cash value. They're going to be like, oh, YK, I think you can take out whatever 50, 60K every year tax-free for the rest of your life. And this is independent of what the stock market does. I mean, up to a point. But the idea is that the company will keep paying me out even if my cash value falls below zero. Not all companies do that. Some companies, they just pay you out until your cash value falls to zero, and then you don't get paid anymore. So two things you want to, the two reasons I like my policy is because of the living benefits and the lifetime income if nothing happens to me. So with cash value life insurance, you want to get it as young and as young as is feasible for you, because it depends on your age and your health. If you're older, it costs more. If you're unhealthy, it costs more. So this is like, I say as young as feasible because this is something like you're committed to. Like it's not like a Roth IRA where you can just put in money one year, skip the next year, put in the money next year. like you have to be pretty consistent with it to pay in every month or pay in every year. So if you're at a place where you can put that amount of money into a cash value life insurance policy, I think it's a great thing to have, right? But it might not be for everybody. So specifically, why put money into cash value instead of a Roth is because of, so number one is that I can put more money into a cash value life insurance policy, right? I'm not limited to the $6,000 in a Roth IRA. Number two is that as a life insurance product, I have a living benefit, which my Roth doesn't have. I have a death benefit, which my Roth doesn't have. Death benefit is if I die, my family gets money, fantastic. And then number three is the life insurance policy, specifically the index universal life, has the market protection, right? The account value stays flat if the market crashes. With my Roth IRA, if the market crashes, it's going to tank with the market, right? Depending on my investments, but it probably will. So it's better as an alternative for me. It might not be for everybody. That's why I say do your own research. I mean, it's a very powerful vehicle if it's the right time in your life and you know how to utilize it. So the next question is, where would people get a life insurance policy? And the answer to that is you have to get it through a life insurance company. So most people don't know about cash value life insurance, and that's why people, if they want a policy, they should talk to a experienced and licensed, but that's the bare minimum. They have to talk to an experienced agent. Like they can get a consultation by an agent. They can get many consultations by an agent. It's free because the people don't pay for the agent. The company pays for the agent. So with that being said, you want to pick life insurance policies very carefully because this is like a long-term thing. Like it's a permanent life insurance policy. You'll have it pretty much for life, which, it doesn't mean that you'll be paying for life, but this is a long-term commitment. Like you wouldn't willy-nilly buy a car or a house because someone said you should. Like you would do your own research. So, you want to, work with a person who is experienced, number one, like who knows what they're talking about, because having a license is just a bare minimum. And having a license doesn't mean you know what to do. Like you wouldn't let a doctor who just got his degree to do surgery on someone, right? It just doesn't make sense. So number two is you probably want to work with a non-captive agent because the non-captive agents, they represent many different companies. So they know the ins and out of different companies, and they've done the comparison to know which product would be suitable for you. And then number three would be you want to work with someone who has your best interest at heart. Because in the world of cash value life insurance, because it's such a long-term thing, it's very easy to get stuck with a policy or a design that won't benefit you in the long run. And it happens all the time because people have it for 40, 50 years and they didn't know something about the policy, and then the policy might lapse because they didn't put enough money into it in the very beginning. So it happens all the time. So just make sure you know what you're doing and you work with someone who knows what they're doing and has your best interest at heart. And if you engineer the policy in the right way, like you find the right person, they help you do it the right way, like it's a very strong financial portfolio, like a very strong addition to your financial portfolio. And that's why I have one. So with that being said, this is like cash value life insurance. To me, along with the HSA, the health savings account, are two of the most best kept secrets in America for creating a tax-free retirement. And in the next video, I'll be talking about the HSA. So with that being said, I hope everyone has learned something from today's video, and thank you everyone for being here. Have a wonderful rest of the day.